All right, so we're back from break. Um, let's go right back into these examples. And what I'd like you to do now is number three. I'll give you a hint that there is really no difference between the journal entry for an exchange that has commercial substance or an exchange that lacks commercial substance if there's a loss. And the reason for that, again, is that we have to record losses regardless of whether there is or isn't commercial substance. So I'll read the question with you and then I'll give you a few minutes to do the journal entry so you can practice making sure that you know how to do these non-monetary exchanges. Uh, Again, remember everything is now under lacks commercial substance. Bright Company exchanges a used truck with a cost of $20,000 and accumulated depreciation of $2,000 for a new truck. The fair value of the used truck has been determined at $15,000. Notice it's like line for line, the same thing. And Bright also pays $2,000 cash. Prepare the journal entry to record the exchange for Bright Company. So I'll give you 5 minutes until 11:50 to record this exchange. And remembering that when there's a loss, we do recognize losses, even if there's no commercial substance. And then I'll have someone walk us through the solution. And it's okay to take a chance and walk through the solution, even if you aren't sure of your answer. So I want to encourage someone to volunteer at 11:50. Oh, so hopefully someone we haven't heard from yet today. Right. So 5 minutes, finish up your journal entry for number three. Okay, so there's about a minute left. So whoever wants to volunteer to give the answer, if you're ready, you can raise your hand already. So I know who to call on. All right. So who wants to try to answer this question? Okay, Gian, go ahead. I'll go to the sheet here and you tell me what to do. I'm ready.
Yeah.
Mhm.
New truck.
Mhm.
Debited to $17,000.
So you did that by just saying the fair value of the old plus the cash, right?
Yes.
Mm-hmm. So the fair value of the old was 15, the cash paid was 2,000. Good. What's next?
Accumulated depreciation is $2,000, which is debited as well.
Okay, 2,000 debit. Sorry, where's my cursor? Okay, 2,000. Yes.
And um, I should do the old truck first.
Okay. Yeah, that's fine. I know you want to do the loss. It's okay.
Yeah.
30,000, right? Sorry,
$20,000.
20,000. Sorry,
Yeah.
I'm getting confused with the previous one. My bad. Thanks.
No problem.
What's
Yeah.
next?
And cash is
Mm-hmm.
$2,000.
Mm-hmm.
And we got the loss.
Mm-hmm.
She's debited, $3,000.
Loss on disposal or loss on exchange. And so you can see 19 versus 22. So there has to be a 3,000 debit here. Another way to do that is exactly what we did before in number one, right? The fair value of the old truck was 15,000. The book value of the old truck is 18,000 because it's the difference between a 20,000 cost and a 2,000 accumulated depreciation. So you had something on your books at 18,000 thinking that's what it was worth, but then it turns out you only get 15,000 for it, so you have a loss of 3,000. So thank you, that's all correct. And what should be fairly obvious now to everybody is that number one and number three are exactly the same journal entry, even though there's no commercial substance in number three. And that's because when it comes to a loss, regardless of whether there is or isn't commercial substance, you will always record the loss. Okay, so the journal entry is going to be the same, for both. Whereas, and we're coming to this in number four, and I'll do it. Thanks again, Gian. I'll do it with you guys. So number one and number three, same journal entry, even though there is commercial substance and there's no commercial substance. Number four, however, right, has the same language and the same scenario, except for the 3,000 cash, almost the same as number two. There is a gain in example four, but since we lack commercial substance, we already know that with a gain, if there's no commercial substance, we're not allowed to record any gains. And the only time when we can record gains is in that scenario that I told you guys about, where we receive boot, right? Cash, also known as boot. So just to show you here in the book, right, under lacks commercial substance, in the first paragraph over here, and I was going over this with one of your classmates during office hours. When we try to figure out the amount at which we should record the new truck if there's no commercial substance. The rules tell us that we are no longer allowed to look at the fair value of the old truck as part of an indicator of what the cost of the new, well, not truck, the new assets, right? It could be anything, not just a truck. What the new asset would be when it comes to a gain, we actually have to use the book value of the old asset. I summarized it for you in this document because it gets a little bit crazy. I mean, we can tell, right? It's getting a little bit nutty. So the formula to record the new asset, if the transaction lacks commercial substance and we have a gain, if there's a gain and no cash is received, you use the book value of the old asset plus any cash that's paid. If there's a gain and cash is received, you still use the book value of the old asset plus any cash paid minus cash received, and then you add any gain that's recognized. And then there's a long story here about how the gain is calculated and how it may be recognized. This is all better seen in examples that are still coming. But the big change here, right, for a gain situation, if there's no commercial substance, is that this thing that we were doing over here, calculating the new truck cost as the fair value of the old truck, we're not allowed to do that. We have to use book value. So I will do number 4 onwards with you because they've all got to do with gains when there's no commercial substance, but there's all different scenarios like cash paid, no cash paid, boot at less than 25%, and boot at more than 25%. Again, I'll get into it. So let's start with number 4. It's a gain, there's no boot, so you didn't receive any cash and you didn't pay any cash. Bright Company exchanges a used truck, 30,000 cost, accumulated depreciation 28 for a new truck. So this means that the book value is 2,000, right? The fair value of the used truck has been determined at 10,000. Prepare the journal entry to record the exchange for Bright Company. All right. So we go here and start figuring this out. Let me just do this so that it's less confusing about when one question ends and the next one begins. All right. So when we look at number 4, we obviously know that we have to record. We obviously know that we have to record the new truck, right, at some amount. And so I'll go across here and write it out, right? The new truck's cost is just what I was saying before, book value now, right? Book value of the old truck. And this is only because there's no commercial substance, right? Plus any cash paid. We won't put minus cash received because that brings us into the boot scenario, and this is not where we are. So I highlight this in red so that when you look at this document, you'll remember that this is where the change happened, right? Book value of the old truck. So we know that the old truck's book value based on the question is 30,000 minus 28,000, which is 2,000. So 2,000, there's no cash paid. So the new truck is going to be recorded at 2,000. And why do we do this? We have to use book value when there is no commercial substance and we have a gain. That's why we're doing this, okay? There's no commercial substance and we have a gain. What the FASB, what the standards are trying to prevent people from doing is a bogus exchange where they record, the new asset at some fair value amount, and try to basically generate gains out of thin air. Because remember, lacking commercial substance means that the cash flows of the company don't change based on the exchange. So we can't have a gain being recognized when there really was nothing of substance that changed in the business. And as a result, we're not allowed to to use the fair value of the old truck as a basis for the cost of the new truck. And by doing that, I'm not going to go into the long calculation of how this works. It does work, and anybody who wants to see me do this at some later stage, which I'm sure is like zero bodies, but just in case, I can show you that even if you calculate the gain by using the fair value of the old asset, you would have to defer it anyway. So using book value basically eliminates the chance of a company having any type of gain from a transaction that actually has no economic substance. All right, so that's the truck. You're going to debit accumulated depreciation as we've done in the past. It's 28,000 debit. And then you're gonna do the old truck for 30,000. There's no cash paid, no cash received, no gain, no loss. That's the end of the journal entry. They've simplified it. Before you would have to if you treated the new truck as fair value plus cash paid, then you would have to deduct the gain from it anyway, and you end up in the same place. So just remember, when there is a gain and there's no commercial substance, the new truck's cost is now calculated as the book value of the old plus any cash paid. Questions there? Hopefully this is not too tedious, maybe a little bit tedious, but going through all of these examples will allow you to understand every scenario of exchanges. And yes, this will come up again at your 4-year school. So this is something that will be following you around. All right, so you want to make sure that you understand it. So now we have another gain with no cash received, but cash is being paid. Okay. Same scenario, 30,000 cost, accumulated is 28. Fair value of the old is still 10, but now you paid 3 grand of cash. Prepare the journal entry to record the exchange, right? So going back here, let's see how we do this. Give myself a little bit more space here. Again, this is a gain, no cash received, but there is cash paid. So you just start again by, laying out, you have to put the new truck stuff. If you get stuck and you're like, oh my, I have no idea what I'm supposed to do, just go around it and fill out everything else that you know. I mean, that accumulated depreciation is sorry, I shouldn't go there. That accumulated depreciation is 28,000. That the old truck has to go out, right, at 30,000. I mean, this is the thing with accounting, you can get partial credit on some of the stuff. That cash was paid because it said in the question, cash was paid at 3,000. So you can basically back into, right? You can back into the cost of the new truck. If you say, okay, this is all the credits, but the debit's only 28,000, that means that the new truck's cost has to be 5,000, right? So where does that 5,000 come from? You're taking the book value of the old truck, same formula, and we have to use this formula because there's a gain but no commercial substance. The book value of the old truck is $2,000. We paid an additional $3,000 in cash, so it must then mean that the cost of the new truck is $5,000. So you either do it this way or you just plug the number by balancing your debits and your credits. All right, but that's where the 5,000 comes from. It's the book value of the old plus the cash that's paid. I wrote it for you over here in your kind of cheat sheet. Okay, so that's gain, no cash received, cash paid. Questions, anybody? Okay, so I'll push on. We've only got 2 more to go, right? Thank goodness. Number 6. Now, there's still no commercial substance. There's a gain, and you are receiving cash. Okay, you're receiving cash, and this is where you use, remember I told you there will come a time when we have to use this formula, the boot formula, and this is going to be that time, okay? Because what's happening here now is that we are allowed to recognize some portion of the gain, whether you read it on the notes that I prepared for you, or you can read it in the book. This is what I'm talking about. The book has like this different scenarios. It can look a little bit overwhelming, but I'm breaking it down for you in examples, right? So if there's a gain, and the gain is less than 25% of the fair value received. When they say fair value received, they mean the cash plus fair value of the asset that you receive, then you have to use this boot formula. And let me just go over the formula with you, all right? So actually, let me read the question and then we can see how the formula could be applied to the question. Might be a little bit easier because we have something to refer back to. So Bright Company exchanges a used truck. We already know this, 30,000 cost, accumulated depreciation 28,000 for a new truck. The fair value of the used truck is 10,000. All sounds familiar, but now Bright also receives $1,000 cash as part of the exchange. We haven't seen this before, right? Where cash is being received. The fair value of the new truck is estimated at 11,000. That's also new information. It's kind of obvious because you're giving up a truck of 10,000 and receiving 1,000 cash, so it makes sense that the fair value estimate of the new truck is 11,000. Prepare the journal entry to record the exchange for Bright Company. Now, under normal circumstances, we'd say, well, there's a gain, there's no commercial substance, so we can't recognize the gain, but there's that exception, right? When you receive some cash, you can record a portion of the gain. And so you're going to use this boot formula to figure out how much of the gain you're recognizing. So the cash received, in this case, the 1,000 would be the numerator in the formula. Then the denominator is the cash received, which is 1,000, plus the fair value of other assets received. This is the fair value of the new truck. So that's 11,000 multiplied by the total gain on the transaction. And the gain here would be calculated as the fair value of the old truck minus the book value of the old truck. So we revert back to that old gain calculation that we've been doing all along. And when you apply this formula, it tells you what portion of the gain can be recognized. This is really painful stuff, right? I mean, if you look at it, it's not easy. It's not easy to follow, and the reason this is so involved again is because the standards, the accounting standards codification, the FASB, however you want to say it, they're trying to prevent companies from recognizing gains that don't really exist, right? Because the transaction lacks commercial substance, but because you received some money in return, for as part of the transaction, they do realize that because you got money, you realize some part of the gain, and you should be able to record some part of that gain. So they're saying, what is the cash that you received as basically as a percentage of all the assets that you received? And so the cash is, physical realization of some of the gain. So you can multiply that fraction by the total gain to get to the amount that you're allowed to record. And if you feel like your head just burst after I said all of that, I understand. It's not easy. I will show it to you in the answer, and then maybe it will become clearer, or it may also just not be clear ever, right? I hope that's not the case. Okay, so let's try and see if we can work through, maybe not ever, but it may be clear with like 2 or 3 more go arounds to get this right. So this is a gain with some boot. It's less than 25% of the fair value of the asset that you're getting. So, pardon me. We have obviously the new truck, right? We can almost kind of start writing out these things before the time we know we have accumulated depreciation. And that goes in, just type in what you already know, goes in at 28,000. You know that you also received cash, right? You received cash of 1,000. That needs to be recorded, right? All the weird stuff that I was discussing has just got to do with the gain recognition. It doesn't have to do with the fact that you actually received cash, right? Then you know that you also have to get rid of the old truck. This is all stuff that we know from before, 30,000, right? Now we know that there's a gain, right, on the exchange, but we have no idea how much gain we're allowed to record. We also know that there's a new truck, and it's still unclear how much the new truck should go in at. So I'll start with the new truck. You end up asking, well, how much should the new truck go in at? So I can't use this formula only because there's a gain now. So and cash received. So I'm gonna have to go to this long formula: book value of the old asset plus any cash paid minus cash received plus any gain recognized. Okay, so we'll go in here and say, what's the new truck cost? Right? It's the book value of the old truck plus any cash paid minus any cash received, right? And then is it plus or minus? Let's go back, plus any gain that is recognized. This is formula driven. So, you're going to have to make sure that you are on top of these formulas. It's not something that I'm making up or whatever. This is how we end up getting to this number. So let's see if we can figure this out. So the book value of the old is not hard. It's 30,000 minus 28,000, so it's 2,000. Was there any cash paid? If you go back to the question, you see that there was no cash paid. It's zero, right? We didn't pay cash in the scenario. What we did do, and I'll go back here, no cash paid, but what we did do was receive cash. So it's minus 1,000, right? We received $1,000 cash. And now we have to add the gain that's recognized, but we don't know what that gain is because we have to use this crazy boot formula to come up with the amount of gain that we're allowed to recognize. So we'll leave that open and first say how much is the total gain, right? How much is the gain itself? And so the gain is going to be calculated as the fair value of the old truck minus the book value, right? Or compared to the book value of the old truck. This is coming from before, back in the day when we were just doing regular gains and losses. That's how you calculate them. So you go back to the same, compare fair value of the old to book value of the old, and that's going to give you the gain on the transaction. So in this case, when we go back, it says that the fair value of the old truck is 10,000. We know that the book value is 2,000. So 10,000 is the fair value, 2,000 is the book value, cost minus accumulated depreciation. So the gain itself is 8,000. That's the total gain. But what you have to be aware of here, based on this boot situation, the cash received, we are not allowed to record this total gain. We have to use the boot formula. And so now the formula I guess it paused. Okay, so the formula is cash received, right, divided by the cash received plus the fair value of other assets received. That's how you remember it. And so now the cash received, obviously 1,000. And the fair value of all other assets received is the truck is 11,000. So we're going to say 1,000 divided by 1,000 plus 11,000. That's how it looks. So I'll put the equal sign here so you know I'm carrying on with the same thought. And so what does that mean? In the end, the portion of the gain that you can recognize is $667. This is the amount of the gain of 8,000 that we are allowed to recognize. So the gain becomes 667. If you're calculating with me, I'm just rounding a little bit. And then that same 667 goes up here, right? That's coming from all of these are the same number going to different places. And so in the end, the new truck is going to be all of this stuff together. So obviously you could also just solve for the cost of the new truck, but in the end, the formula gets us to the same place. The new truck is going to have a cost of $1,667. Questions, people? They have to be questions. No?
I have a question.
Yay.
Actually, how to got this 667?
Yeah, so it's basically 1,000 divided by 12,000.
It's like 0.0833.
Oh, what did I do wrong here? Oh, times 8,000. Oh my word, thanks, Antora. You're awake and I'm not. I didn't multiply it by the gain. Thank you. Okay, so there you go. I jumped the gun and you still have to multiply it by the 8,000 gain. It is 0.83, and I should have done the math over here instead of just typing in the number. That's the fraction, and then you multiply it by the actual gain, and then that 667 is the portion of the gain that you recognize. Makes more sense? Do you get to the same answer as me now? Let me do it over here to make sure that I'm not going crazy. 1,000 divided by 12,000 times 8,000. Yeah, all right. Thanks for pointing that out. So with the formula that I should have, that's this
I'm
piece.
sorry, I have one more question.
Yeah,
This
ask.
fair value here is 11,000, but we have a fair value 10,000.
No, you
1,000.
You have to be careful. Fair value is 10,000 of the old truck.
Yes.
Fair value 11,000 of the new truck. Go on. And the new truck is what we received. That's why I'm using 11,000 and not 10,000.
Okay.
Got it? So the formula dictates that I have to use, if you look here, right, other assets received, not given up. That's a good question you're asking, right? Basically, we're working with how much cash did we receive, what other assets did we receive, and that fraction you multiply by the total gain on the transaction.
Thank you.
You're welcome. Thank you for asking. And you helped me to fix an error that I had. So that's great. Other questions? Okay, so we're almost there. We're almost at number 7. But again, I want to remind you, if you prefer to read, these things in the book, there is a whole table here that tells you, if there's commercial substance, if there's commercial substance, blah, blah, blah. Everything that I'm saying over here is this on the work that we're doing together is the same as what's going on in the book. We're coming now to number 7, which is basically the last, I guess, type of scenario that you can have with this commercial substance and cash received. And this is going to be the scenario where the cash that you are receiving in the transaction is at least 25% of the fair value of everything that is being received. And so if that's the case, so basically if you get a whole lot of cash and the cash is at least 25%, and a question would either make this obvious or actually tell you, then what ends up happening is you're allowed to recognize the entire gain. I guess the FASB decided that at some point, because someone's getting cash in return in the exchange, that they should be allowed to record the gain. 25% is a little bit arbitrary. Don't ask me why they settle on 25%. I mean, it's only really a quarter of all the fair value of the assets. Maybe they just think that a gain up to a quarter, of the fair value, recognizing the gain, maybe it won't be as much as a quarter of the fair value. I have no idea, but 25% is the hard number, the percentage. At least 25% is basically 25% and above. If your cash is 20%, it's too bad. You're only using the boot formula. But if it's 25% and above, you are recognizing the entire gain. Okay. And remember, losses are always fully recognized, so you don't have to worry about this in the context of losses. So looking at number 7, Bright Company, same story. The exchange is 30,000 cost truck, 28 accumulated depreciation for a new truck. The fair value of the used truck has been determined at 10,000. Bright also receives 8,000 cash as part of the exchange. Prepare the journal entry to record the exchange for Bright Company. So in this case, the 8,000, I think you can compare it to the 10,000 fair value of the used truck. I think that this question is somewhat deficient because we probably should have, and I'm just going to do this. If you're all right, I'm just going to actually show the piece that I think should be in the question that's not there. I think the question is a little bit deficient because it should actually also tell you the fair value of the new truck. But in any event, the 8,000 is more than 25% of the fair value of the used truck. It's, if the fair value of the new truck was 11,000, it's more than 25% of that. If we go back to the theory, it says the cash constitutes at least 25% of the fair value received. So that's why I was saying this question's a little bit deficient, because you want to know what the fair value received is. And in this case, you should at least know the fair value of the new truck. So we see the 8,000 as at least 25%. So let's do the journal entry, right? And I'm going to go over here. So this is number 7. We don't need to use this boot formula, so that's a win, right? We just have to do our journal entry basically as before. So it's a new truck, right? I'm just going to type in the stuff that we, by now, you know how to do a disposal over and over because we've kind of done it. It feels like a million times already. There's the, sorry, let me go back. You received cash. I'm getting ahead of myself. We received cash of 8,000. So we record the cash. Right? There's the old truck to get rid of. 30,000. Right? And then we have to figure out what's the gain that we can record. And we also have to figure out at what amount are we going to record the new truck, right? So just going back to the gain, this is stuff that we've been over already, right? The gain is always the fair value of the old truck versus the book value of the old truck. That's basically what did you have on your books versus kind of what you got for it. So it's going to be the 10,000 fair value given in the question, right? As stated, the used truck is 10,000 fair value. The book value we know already, 30,000 minus 28,000 is 2,000. So it's the same 8,000 gain from the previous question, right? 8,000. That's going to be the gain. So because the cash received is more than 20 or is 25% or more of the total fair value received, we can record the entire gain. All right, the entire gain gets recorded. And now, obviously, you can say 38,000 over here. There's only 36,000 over here. So it should be a 2,000 cost for the new truck. And so let's see if that works out, right? How do we calculate the cost of the new truck? Because there's a gain, but no commercial substance, we say the book value of the old truck plus any cash paid. Book value of the old truck is 2,000. The cash paid is 0. So it's the same 2,000, right? You could either plug it or you could just calculate it as we have before, 2,000. So either way, the answer is 2,000. So we maintain that because there's no commercial substance, the cost of the new truck will be calculated based on the book value of the old truck. But because we received so much money, right? Remember the rules here that if cash constitutes at least 25% of the fair value received, the entire gain is recognized. And when the book says fair value given, they mean the old asset. Okay, given versus received in the book. Given is the old asset. Received is the new asset. It's the same kind of terminology. So that's how number 7 looks. And we recognize, I'll just put here again, we recognize the entire gain because the cash is 25% or more of the fair value received. Questions there? Or anyone want to audit my answer to make sure I didn't make any mistakes? All right, so I'll give you a minute or two to take down that answer, but that's the bitter end, right? Of non-monetary exchanges. It's not it's nothing to be trifled with. It's a lot to remember in terms of the different ways to answer the questions. But I want you to know that the first question you always have to ask is whether the exchange has commercial substance or lacks commercial substance, because if there's a gain, that answer is going to determine how you move forward. Okay, remember with a loss, it doesn't matter whether there's commercial substance or not, you always report the loss. But with a gain, things get a little bit tricky depending on whether there's commercial substance or not. All right, so that's the answer to that. The handout, which I also incorporated into the revised chapter 10 notes, has all it's kind of a quick reference sheet for all the information that we already did via the examples, But if you wanted to sit and just look at it again, you're welcome to. Otherwise, you can use this as a reference, which is the same, the same information as before. All right, so that's the end of non-monetary exchanges. For I'm going to let us go early because I think we've done enough today. For next time, we're going to go through self-constructed assets, specifically interest capitalization. It is something, like I said before, that people have a little bit of difficulty with sometimes because the calculation that you have to do around it gets a little bit, I guess, involved. So I guess what I suggest to you is if you like, especially for the people already done with the test and so on, and just want to get ready for Wednesday, take a look at this example number 3, or you can just read interest capitalization in the, sorry, this I'm in the wrong thing, or just read interest capitalization stuff in the book. It's up to you. But basically find a way, whatever that way may be, to try and familiarize yourself with how the calculation runs, to be able to figure out how much interest has to be capitalized. It will help you a lot as we move through the remainder of this chapter. This is it's usually a pretty big calculation. So, I don't want you to come in here on Wednesday and have the shock of your lives when you see, how long the calculation is going to be. So with that, I think I can have mercy on you guys, right? Because some people are still in the throes of trying to finish the quiz and the test. I'll give you 15 minutes back to either sit here with me. I'll still be here until 12:45 asking me questions, or otherwise you're dismissed if you just want to go and take a break and start doing the test or the quiz. Otherwise, I'll hang and hear from people if they have questions for me, okay? So you're dismissed unless you want to stay on and ask me any questions. Please be ready for interest capitalization on Wednesday when we'll conclude chapter 10.